Mohammed El-Erian, President, Queens College, Cambridge University, and Chief Economic Adviser at Allianz. Mohammed, great to talk with you once again. Let's begin with the Federal Reserve and what we heard from Fed Chair Jay Powell earlier this week. I think sounding a little bit more dovish after some fairly hawkish economic projections, perhaps back in June. How did you read his comments and the market's, let's say, muted reaction to sort of what we heard? If anything, maybe more of a risk-on type environment in the wake of that.
Good morning, Myles. Thanks for having me. Yes, he was more dovish than the statement, and that was a boost to markets, and rightly so, because what he basically told us is that we don't have to worry about growth. It's going to be solid. We don't have to worry about inflation. It will be transitory. We don't have to worry about elevated asset prices, and that he will maintain the 120 billion of monthly asset purchases for longer than the markets expected. The market now have pushed back the expectations of taper till the end of the year.
Mohammed, it's Julie. Good morning. It's good to see you. We got inflation numbers this morning, of course. We got the PCE deflator month over month in June. PCE deflator, up 0.5%, a little bit lighter, a little bit better than had been estimated. But I know you have been consistently on record saying you don't think inflation is transitory. What would you have to see that would sway you from that view?
So I think we need to keep an open mind. And that's particularly true for the Fed. In the old days, the Fed used to talk about the two tails of the distribution. It used to talk about insurance against both of them. Now we have become a one-sided Fed. This conviction that inflation will be transitory. It's a conviction. What we're hearing from companies suggests that we should have a more open mind. They're telling us about input costs going up, labor costs going up, transportation costs going up. They tell us they don't see the light at the end of the tunnel for these three things. They tell us they have more pricing power. So the only thing I'm saying is keep an open mind. And what I will look at is what companies are telling us. I would like companies to tell us that there's less cost pressure and that they don't feel inclined to increase prices. That's what would make me feel comfortable that inflation is transitory.
And so, Mohammed, how do you think about the bond market then? And Jay Powell himself, I wrote about this a few days ago. He said he's not so sure what to make of the decline we've seen in the 10-year. How have you thought about, that rally on the long end of the curve?
So if the Fed is going to be more dovish than people expected, if it will continue buying emergency level bonds at 120 billion, if it's going to continue buying mortgages, even though the housing market is red hot, then the bond market will respect that. You want to respect the buyer, especially when the buyer happens to be the Fed, printing press in the basement, pursuing non-commercial objectives, meaning it is not price sensitive. And what you get are people buying ahead of that. Who's buying? Foreigners are buying. People with asset liability matching needs are buying. So what you really get is a compounding of the fact that the Fed is continuing to buy for longer than what most people think was going to happen. And indeed, quite a few people think they should be starting to taper now.